Hello guys and welcome to my channel. Today we are going to know about fundamentals of credit. To know about fundamentals of credit, first we have to understand what credit is. So to understand what credit is, we are going to take an example. In our example, there are two persons A and B. Suppose A is a person who is in need to buy a thing and B is going to help him. So B will provide a resource to A so that A can fulfill his needs. Okay, but A will not give B in return anything immediately. That means there will be no immediate payment to B from A. This concept is called credit. Okay, now as we have done an example, now we are going to study the meaning of credit. So credit is created when one party receives resources from another party without an immediate payment. Credit is essentially a promise to pay for something of value with interest charged by lender. Lender means who is giving the resources to the needy person or to the person who asks for the help. Why credit is important? So credit is important because it helps companies and individuals to purchase things they need now but could not pay for it in full. There are three sources. First source is cash, second equity, third credit, and credit is also known as debt. So the next topic that we are going to cover in this video is type of credit. So there are three types of credits. First, revolving credit, second, installments, third, open credit. First, we are going to talk about revolving credit. A revolving credit means it is actually a line of credit that has a cap or it has a credit limit. So a person availing this credit have a limitation to spend or to avail his credit. The example are credit card for revolving credit. If we come to the next, it is installments. Installments means a loan for a set amount with a predetermined repayment structure. Examples are mortgage, auto loan, student loan, house loans. All of them have a predetermined repayment structure. They have like a amount of principal plus interest as their installments. So it reduces amount of principal as well as adds amount of interest on principal due or principal outstanding. So the last to the list is open credit. Open credit is a credit that is due in full of each period. Examples are utilities, phone bills, and trade payables.
Interest is a very important component in credit. It is charged on principal amount due, or we can say that interest is charged on borrowings. It is also known as fee of borrowing.
So there are two types of interest. First, regular interest, then accrued interest. Both of them have a same calculation methods. Simple, compound, simple, compound. So, regular interest means interest is due on principal outstanding and paid in cash. So the cash is paid. But if we come on accrued interest, the main difference and the only difference is that it is not paid and it is paid at last. So now we are going to talk about type of loans. So there are two type of loans. First, secured, second, unsecured, and both of them have a same category again: amortized and non-amortized, amortized and non-amortized. So secured loan is a loan which is guaranteed by us by a asset or something, so that if a person is not able to pay his loan, in that case a lender can use that asset to settle his loan. He can sell that asset to get his principal amount recovered. Whereas if we talk about unsecured loan, there is no such type of securities kept against a loan. So unsecured loan is more riskier than secured loan. The example of secured loan is Journal Security Agreement. Secured loan is also called a mortgage loan, where a person mortgage property against his loan. Now, amortizing means spreading the principal amount over a period. In this case, the principal amount will decrease over the time. Payments are designed so that loan is paid off at a defined end rate payments and may be over some time. Benefits of amortizing loan is reducing principal amount and reduce interest cost. Meaning of non-amortizing loan is where a full payment is made at the end of loan term and the interest is paid at a defined intervals. It can be either of monthly, quarterly, half yearly, or even yearly. Benefits of availing a non-amortizing loan is at the end of the month, burden of interest is reduced. Only the interest amount is paid. It requires a less cash flow. So, in this video, we have covered what is credit, meaning of credit, why credit is important, type of credit, interest, type of interest, and type of loan. In next video, we are going to cover journal process of credit, type of credit analysis, and 5 C's of credit.